This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil. So what we're going to do today is cover the basics of the pullback trade. Now, I'm not going to talk about MACD and ADX, so don't be disappointed, but I want you to understand these basic concepts because it is incredibly important. It's the foundation. It is where if we understand how to trade these two time frames side by side with the material I'm going to talk about today, it's going to improve your timing, number one. You're going to be able to lower risk on your trades, okay? And you're going to have the ability to pull money out of the market on a consistent basis. That's assuming that you understand and you can emotionally handle when you have a few losing trades, number one. You also have to be able to have good money management techniques, and you need good trade management techniques. But with that said, I'm giving an approach that I think you can use pretty consistently in any time frame you want. I'm using a monthly, weekly. You can do it on a 5-minute and a 1-minute if you want. I did that for a long time on intraday charts. All right, let's go ahead and get into this. First, let me just tell you, the technique that I'm going to talk about today is in this book. It is also in the courses extensively where I add in the MACD and the ADX. And I think they can be advantageous, but this will give you at least the basics. And so go to rabilstockresearch.com/book if you want more information on this. So I've got the chart of CEIX up with a monthly chart on the left and a weekly chart on the right. And what we want to do here is always start with the higher time frame, because what the goal of this play is, this is the simplicity of this play, is we're trying to find a trend on the higher time frame. Okay, we're looking for a trend. I'm going to show you how you can define the trend. All right, now I'm not going to go into MACD and ADX on this because I want you to understand the basic concepts. When I originally started doing this, and with the back tests that I've done, that if you go back to some of my older videos, I did a back test that goes back 10 years for both monthly, weekly, and weekly daily, using these basic concepts. And if you do this, you don't necessarily, in other words, the backtest did not include MACD and ADX. Now, my subscribers know the reason why I've added that in, and I added that into the courses especially and gave a lot of detail to that, is that can really zero you in, because the issue becomes if there are 10 stocks to choose from, we need to kind of be able to narrow that down. That's where the MACD and the ADX add a tremendous amount of value. However, we need to understand the basics of what we're trying to do first. Before we start to narrow the field, you want to know what is meeting the criteria, the basic criteria. So I want to cover that, and I want you to understand what we're looking for is buying a pullback in an existing trend. Okay, we're trying to buy a pullback in an existing trend. That is the goal. That is the one basic concept that I think if you can get good at and do it, it's like what you'd call a weighted coin. You're flipping a weighted coin. And you can consistently, with good money management techniques, good trading management techniques, you can consistently pull money out of the market. But you do need to understand a few basic concepts here. So first of all, we want a stock that is trending. All right, we want a pattern of higher highs and higher lows. We don't necessarily looking for something that's going sideways from a price standpoint. All right, so that's going to eliminate a lot of stocks. Now, if you use this second criteria, I would say 90% of the stocks that are going sideways are going to be eliminated. Okay, because what we're looking for is an 18 MA on the higher time frame, a simple 18 MA that is rising above a rising 40. All right, we want both rising. And we don't want the 18 to be rising at a dramatic level faster than the 40. If this is the 18 here, we don't want this accelerating away from the 40. We also don't want that 18 to be losing its slope after being up for an extended period. All right, this is not that bad. That is, to me, that has losing a little bit of slope, but it's not like, it isn't really at the point of looking like it's rolling over yet. Now, if this were to start to do this, it's still considered rising, but to me, that's kind of like, okay, I'm probably pushing the envelope here. I don't really want to be looking for that. So we want to have a rising line where if you look at today's action relative to 3 bars ago and 5 bars ago, it is rising. All right. So that's kind of that's my criteria. All right. Now, and in fact, what you might do is say 5 bars ago and 10 bars ago. 3, I don't know if you need 3, but you'd say you'd want to check 5 bars ago and 10 bars ago. Make sure, that line is rising relative to those 2 prior points. All right, so we've got that. Now, if we have that and both these lines are rising at about the same rate, they don't have to be parallel, but they have to be close to that. All right, they want to look semi-parallel. All right, now, and I know I'm going to get a question in the comment area that says, why do you use an 18? I use an 18 because I do want to watch this slope very quickly. How quickly, if it turns, it's going to turn a little bit more quickly than a 20. But there's nothing wrong with using a 20 and a 40 if you prefer. If you've been using a 20 for the last 10 years and you want to stick with the 20, just use it with the 40 like that. It's no problem. It's not a big deal, okay? All right, now, here's what I want you to understand. We have defined the trend on this time frame. Now, how do we define a pullback? Okay, the way I define a pullback is using the smaller time frame. And I call it, and I took this from a guy who is a expert trader on the E-mini, a guy named Don Miller. He calls it an opposing trend pattern. I call it a pattern. He calls it an opposing trend setup. All right. And what we're looking for is this trend is up. And we are now waiting for this to be down. Now, how do I define down? Well, that's where the 18 is below the 40. Both those lines don't have to be falling, but we want the 18 to be below the 40 and we want price to be below both of those lines. So that's how I would define it. That line is below right here on this bar right here. The 18 crosses below and price is below both. Okay. Once we have that, we now have an uptrend on one time frame. Oh, I'm pointing to the wrong one. So looking at this on this bar right here, this coincides with this, which is two rising lines, and we've pulled back on the higher time frame in the trend. So we're in the trend and we're trying to identify an entry to get in. We want to get in on this chart, but we're going to use this for the timing. Okay, now we don't want to buy the moment this crosses down below. What we need is a trigger. So that's why we call it an opposing trend trigger, OTT, opposing trend trigger. So that is where we now have the opposing trend, and now the trigger would be coming up through both of those moving averages. So that's kind of like the minimum criteria. Now, as you know, as anyone who's been watching any of these videos for an extended period of time, you know that I tell you that the trigger can be different every single time. And I'm going to show you 2 different versions. There's one trigger and here's another trigger. I'm going to show you how they look different, right? So this is the lower time frame. This is the upper time frame. We have 2 signals, 1 pullback, 2 pullback, okay? This is the opposing trend here developed on this bar, actually off of this bar right here where the 18 crosses down below, and we close below both. Okay. Now, what we're looking for is a close back above both those lines. Well, that doesn't happen until here. On this situation, we did it right away. On the first move to the upside, we crossed back above the 40 and closed above it. You see how when we crisscrossed here, we crossed above, but we never closed above. You see that? Now, this time it closed above and we had the start of a new signal. All right. Now, I go into a lot of depth in my book, as well as my courses, on how we can identify a change of trend and how we can look for the 2. So if this is a 1 breaking the trend line, and 2 would be the test, and then 3 would be coming back up. And if we have the right situation in place, we don't have to wait for the 3. Now, if you notice on this trade setup, we don't really have that. You see how this is closing above? And this one is more complex because it came down, rallied up, moved down, rallied up, came down, rallied back up. You see that? And this basically went down, came down, rallied up, turned down, and then turned right back up. So what I'm doing is I'm using the close above both moving averages as the opposing trend setup. Now, here's the problem. When we make this kind of a situation like this, we have to use the low of the pullback. And you could use the low of the last swing low. So you still got to be, if you're putting a trade on here, you've got to put a stop way down here. Now, in this situation, if you're getting a close here and you're using this as the last swing low, you see how it's a little bit more beneficial in this situation, because by using the last swing low in this pattern, it's not as far away. This is pretty far away from your entry. You're risking almost 20 points. And in this case, you're risking maybe about a little over right around $10, okay? So you want to understand these concepts, because that is why I added in the MACD and the ADX, because it can really help us identify why this is not ready yet. We need a pullback. And MACD in this situation is what would be doing that for us. But you do need to understand, and what you can do is take that trade and put a stop here. You can take this entry here and put a stop here. All right. And you can do that without the use of the indicators. It can be done, and we back tested it. It's a pretty impressive. The numbers are pretty impressive. You can go back to an older video that I did a few years ago that goes into all that detail. But the main point I wanted you to understand is, if you can use these two time frames together, right? This time frame is helping with the timing and the risk. And this time frame is telling us that we have a trend that we're trying to get in on. We just want a better entry. We don't want to buy up away from the moving average, way up here or something like that. We want to get it closer to the moving average. The way to do that is to learn how to play the opposing trend trigger on the smaller time frame. Once you get these concepts down and understand the basics of this criteria, then we can start adding in the MACD and the ADX. And I've done numerous videos on how to add those in to improve our timing, reduce our selection. If we have 10 or 20 of these happening at the same time, we can isolate the 3 or 4, maybe even 1 or 2 that look the best and know what the triggers are. All right. So hopefully this helps just give you an understanding of the basic process that you need to have, I think, to improve your timing. All right. Let me know if you have any questions or comments. Thanks.